I'm Jenny Brown. Welcome to MFB News. Hope everybody is really well. You've had a fantastic week since we last caught up and everything is good in your world. Lots of good stuff for you today, but it's going to be a very, very quick episode. I'm sure some of you will be sighing with relief. I'm sure I'll still wish you on for ages though, because we're doing some very exciting filming of our webinar today on incorporation. So definitely one to catch up on. If you haven't booked your place to watch the webinar, please do. It's going to be really interesting. We've got a fantastic tax advisor, Sean Hughes, coming in, and head of underwriting, Brett Mason at Lambay. So going to be really good. So we're going to keep this video today really short because I've got to dash off and go and do that. But we are going to still cover off some good content this week, not to fear. We're going to talk about swap rates. We're going to talk about lender pricing changes, the consistent theme that we have every single week. We're going to talk about limited company structures. This is something which has come up quite a few times in the last few weeks. And I think it's just worth kind of digging into a bit for those of you who are either contemplating using a limited company going forwards, or indeed, if you have a limited company, you've started fiddling around with the shareholding structure, it's going to be interesting for you guys. Quick touch on the Renters' Rights Bill, quick look at inflation and what that means for base rate predictions, and then we're going to wrap it up for the week. Okay, so let's kick this off with swap rates and what's been going on there. And I really want to just kind of caveat this, that the latest swap rate information that I have is as of 11 o'clock on Tuesday evening. I'm recording this video on Wednesday morning. We've had the news come out about inflation easing off ever so slightly. There's no escaping the fact that inflation is very persistent, but just keep in mind that when I'm referencing swap rates for you now, we've had the inflation data come out, which may serve to alter things. And let's hope they alter things favourably, because unfortunately, as of last night, 5-year swap rates had ticked over the 4% mark again, which is so frustrating. But it is what it is. So 5-year swap rate, just over 4%. Comparatively, 1 month ago, 3.87, 1 year ago, 3.82. So I mean, look, in terms of differences, we're talking about sort of, 0.0 something of a percent. So the actual change is not massive, but still to find ourselves in a position where we are seeing higher 5-year swap rates than we were 1 year ago is just so frustrating. Now, a slightly better picture in some ways on 2 years. So 2-year swaps as of last night also at 4%. 1 month ago, 4.1, 1 year ago, 4.8. So the good news is we're kind of ahead of the game year on year, but still things are stuck at 4% as well. So actually, I think the reality is 2 and 5 year swaps are just at 4%. And like I say, we can't see huge amounts changing in terms of fixed rate pricing for the time being. Now, we have had the inflation data come out. We'll talk a bit about that in a moment and what that means for base rate predictions going forwards. We've also got the spring statement coming out as well in the next few weeks, which could alter things as well. And there's obviously a lot going on in the world. But fundamentally, for those of you who are kind of really hanging on and waiting for a notable shift in fixed rate pricing, I think the reality is that we just kind of are where we are. I've seen quite a few people now referencing that we're at a new normal, things have stabilised and this is just where we are. We may see a kind of reduction of 0.1, 0.2%, but broadly speaking, this is kind of the new normality. Let's wait and see. Now, in spite of all of this, we have seen some lenders bringing their rates down in the last week. Not huge reductions, but reductions nonetheless. So let's have a quick look at those. We've seen the Family Building Society reduce some of their rates, but up to 0.1%. The Family Building Society they're an amazing little lender actually. They do some really quirky stuff, so they're very good at expats, particularly good at expats on the buy-to-let side of things. Reasonably well priced for limited companies as well. I think it's fair to say that their expertise and their specialism really sits around the borrower rather than the property. So what you often find is that some lenders are able to take on board more racy properties. So as by that, what I would be referring to is HMOs, multi-units, things made from unusual construction, that kind of stuff. But actually the family really come into their own in terms of the actual borrower's situation rather than the property itself. Now, we've seen Santander bring their rates down by up to 0.15%. Great, that's perfect. Santander, as I mentioned a couple of weeks ago, they're a very sort of vanilla lender. So they don't want people with large portfolios. They're certainly not lending to limited companies or in any sort of racy properties. They do have a place in the market, Santander, volume-based, high street lender, good pricing. Also, actually, one of the things that they do extend their lending policy from residential or homeowner mortgages to buy-to-let, which I think is quite unique, is they tend to say, look, if we would lend on it if it was your home, we would lend on it as a buy-to-let. Now, a lot of lenders actually have different policies in terms of the properties they would accept between homeowner and buy-to-let. So the fact Santander have this policy is great. This means they're able to take on things like eco homes. So if you've got a slightly unusual property that's not an HMO or multi-unit, so by unusual I mean mainly construction type, and you're looking to borrow personally, Santander could be a home for you. Now, we've seen Accord mortgages bring rates down by up to 0.15%. Again, same as Santander. Again, very standard lender, maximum of 10 properties in the background, no limited companies, no multi-units, no HMOs, that kind of stuff. Very good pricing, and service is excellent from Accord. So if you need to move quick and you fit into one of those categories, they could be a good home for your mortgage. Now, we've seen Landbay reduce some of their rates by up to 0.1%. Landbay, by complete contrast, specialist lender, so they are lending on HMOs, multi-units, to limited companies, and also trading limited companies. They don't mind if you've got, 1,000 buy-to-let properties, they're happy to take you on. So a specialist lender making rate reductions there. We've also seen United Trust Bank bring their rates down. Now, don't get excited about this because it just really kind of reflects how out of kilter their pricing was in the first place. They brought their rates down by up to 1%. Now, UTB, United Trust Bank, are a very specialist lender. Where I would say they really excel is the kinds of properties they would lend on. So, as I was saying about the family building society earlier on, they're all about the borrower. They can lend on some unusual personal situations. United Trust Bank are definitely all about the property. So these guys are super good at flats over commercial. So, for example, if you had a flat over a takeaway, which a lot of lenders would decline, they're very, very good at that kind of stuff. So good to see them bringing their rates down. But like I say, a 1% reduction is not kind of paving the way for other lenders to make a 1% reduction by any means. It simply means they were charging way more than they probably had to in the first place. And finally, we've seen Mortgage Trust reduce their HMO rates and, more interestingly, increase their loan to value on HMOs from 75 to 80% loan to value, which is fantastic. Now, RMT, the first lender who will do 80% loan to values on HMOs? Absolutely not. There are quite a few lenders who are offering this already, but really, as I mentioned in previous weeks, what this does when a lender increases their maximum loan to value is it really sends a message in terms of where they think house prices are going to go. If they were expecting house prices to come down, they simply would not be looking to expand into a higher loan to value space because it would leave their risk wide open. So actually what this tells us is that the people at MT Finance are certainly expecting house prices to remain consistent and actually probably increase over the coming years. Okay, now this week I just wanted to dig a bit more into limited company ownership structures, and I think the reason this is important is that more and more people are looking to use limited companies as a vehicle to own buy-to-let properties, and people are thinking about using limited companies particularly because of the taxation benefits that exist in terms of the way your rent is essentially taxed in limited company versus personally. The trend that we're certainly seeing a bit more of at the moment is people also using the limited company as a means to do some estate planning. So what I mean is that they're actually including their children, generally their children, as shareholders in the business to kind of allow them to do planning for taxation later in life. Now, having a child as a shareholder in a limited company is fundamentally great. To be able to kind of be smart with your estate planning is a really, really good thing. However, there can be some complexities when it comes to obtaining mortgage finance depending on the structure that you've got. So I really wanted to kind of just dig into limited company ownership structures in a bit more detail because I think this is really important. So just to kind of rewind for a moment, when we're saying structures, what are we talking about? So we're talking about who are the directors and who are the shareholders of the company. So generally speaking, I would say about 80% of transactions that we would see would be either an individual or maybe husband and wife, just to be really stereotypical, or a pair of people who are both the directors of the company and the shareholders of the company as well. So it's a very, very straightforward structure. However, the other 20% of the applications that we see, things are not quite as straightforward. So what you might have, for example, is, and again, to be very stereotypical, mum and dad are company directors. The shareholders are mum and dad. They would maybe have, say, 30% of the shares each. and the 2 children would have the remaining 40% of the shares. The kids would have 20% each. That's kind of one example. Now there's also many kind of variations on this, as you imagine, you know, the kind of options are limitless. Also we have situations where we have a limited company which is owned by another limited company, so the shares are actually owned by another company which is then owned by our directors. So there's all the different variations, but the key thing that we're really looking at today is including particularly children on your companies. So when you're applying for a limited company mortgage, the lenders are going to ask for personal guarantees, and a personal guarantee is essentially you saying, look, if it all goes horribly wrong, you have to repossess the property and it's sold on and there is not enough money to repay my mortgage, I am personally responsible for making sure that the lender gets all of their money back so you can come after me as an individual. Now this is the same as if you owned the property personally. So a limited company does not absolve you as the person that runs and owns the company from any responsibility, okay, in terms of making sure the mortgage and your debts are repaid. Now, the reason that lenders will take these personal guarantees is to basically ensure their security, ensure their position is safe. And the lenders will, when they're underwriting the mortgage, look to take personal guarantees, and this is where it becomes complicated. So some lenders will only take personal guarantees from the directors of the company. So they couldn't care less who the shareholders are, they just want personal guarantees from the directors. Some lenders will take personal guarantees from all of the directors and all of the shareholders. Now, as you would imagine, if you've got a 5-year-old who is a 20% shareholder of a limited company, and keeping in mind that your 5-year-old can't legally contract, I mean, they can't even sign their own name at that stage, a 5-year-old simply could not give a personal guarantee. So that would be a real problem for the lender, because part of the people that are going to want to guarantee the mortgage are not able to do so. So that would mean in that situation where a child is a shareholder, that would preclude you from being able to obtain that particular mortgage. The next option that we would have is that we have lenders who will say, well, okay, we're going to take the personal guarantees from the directors, and we're also going to take personal guarantees from those shareholders who own more than a certain percentage of the business. And generally speaking, this would be more than around 19%, okay? So if you had a limited company where a child had a 15% share in the company, but mum and dad owned everything else, that would be absolutely fine. If you had a limited company where a child owned 50% of the shares, mum and dad owned 25% each, that wouldn't work. So the point of this is really just to give you a flavour of, in terms of lenders' appetite and where they kind of want things to, how things to be presented, as to kind of giving yourself the best option of being able to access all the mortgages on offer. So if you wanted to really be able to say, I absolutely want to guarantee that all mortgage lenders would lend to my limited company structure, the structure that we would need to have is 2 adults who are the shareholders and the directors. That's it. That is the structure that would fit for absolutely, well, I'll say everybody. There's never, not everybody will fit with every lender, but most lenders would accept that structure. The minute you start to throw in things like children into the mix, and again, like I say, I'm not saying you shouldn't do it because I do think it's a wonderful tool for estate planning, but the minute you start to include children into the mix, it gets more complicated. So my advice to you would be this: if you do want to bring your children in, and do get the advice of your accountant here, because there's more to life than just getting a mortgage. But from a mortgage perspective, the way to kind of have your children on the company, but also ensure you have access to as many lenders as possible, would be to ensure that your children have a shareholding of no more than 19% of the company. And that would be the combined shareholding, by the way. So if you've got 2 kids, they get 8 or 9 shares each, that would be it. You wouldn't give them any more. So like I said, we've just seen a few clients recently, even clients who have got existing companies where they've changed the shareholding around, they've brought children into the mix, and it's then meant they couldn't get at the kind of lenders who were offering the most competitive rates, and that was really frustrating for them. So really just kind of a heads up that if you are thinking about using a limited company structure, the kind of thought you'd need to give in terms of the structure of the company, the ownership of the company, to ensure you had the best bet of getting the greatest reach into the market in terms of mortgage rates. Okay, now just a very, very quick update on the Renters' Rights Bill, because we know that it's been very, very quiet from the government since the second reading took place in the House of Lords on the 4th of February. So things are going to be moving again after Easter, and the committee stage in the House of Lords starts on the 22nd of April. So that's where we're going to see things start to kind of come forward again. Now, in terms of timings of when the Renters' Rights Bill is likely to come into law, I think I mentioned a couple of weeks ago the kind of consensus was probably October. Because of the delays that we've now seen, we may see things pushed back as far as January next year. Now, that could be a little bit of wishful thinking, but I suspect that the autumn is going to be your absolute earliest. I know at one point people were thinking it was going to come into play, or some parts of it would come into play from the summer. I don't think that's going to be the case. Autumn at the earliest, and possibly January of next year now. We'll keep you updated with the changes, any going forwards as we hear them. Now, very brief look at where people's predictions are for base rate for the rest of 2025. So if you rewind back to autumn 2024, people were feeling quite bullish about base rate actually. Some people saying that they thought it was going to be as low as 3.75 by the end of 2025. Not sure they're going to be feeling quite the same way now. Obviously, things are kind of constantly changing. I mean, it's really hard to know for sure what's going to happen, isn't it? But bearing in mind the situation that we're in terms of GDP, inflation, geopolitical stuff, Donald Trump, all this stuff that's kind of going on, not just in the UK, but offshore as well. And there's so much of it at the moment, isn't there? It is really quite overwhelming when we think about it. But what you'll find is that actually currently the expectation is the base rate will now end this year, having gone down by a further 1/4 or 0.5%. Now, it's very split in terms of what people think is going to happen. My personal view, I can't see base rate going down by more than 1/4% for the rest of this year. But I know there are some people out there who are still very much predicting a 0.5% reduction. And that's us for this week. Thank you so much for joining us. I hope you found that useful. I'll be back again same time next week, hopefully with some more positive news in terms of swap rates. But let's just wait and see. Oh, and by the way, just to say, I am in the office today. I've got some sort of like weird corporate room in my house. People often say to me, you know, do you actually have an office that you go into, or do you just work from home all the time? We do have an office. I just have the very fortunate position of being able to work from home a couple of days a week, and it happens to coincide with our recording day. So there you go. Have a wonderful week. And as always, you do know if you have any questions, you can absolutely give us a shout, 0345 345 6788, or by all means send us an email, drop us an online inquiry, or go on our web chat on our website and you can talk to someone live through there, not a robot, a real life human. Imagine that. Have a fantastic week. See you next time.